Hello friends, welcome back. In this today discussion, we are discussing about budgeting methodologies, session 1. In this today session, we are covering first one master budget or static budget, flexible budgeting and project budgeting. Before moving to these details, we have to understand what is budgeting. Budgeting is the foundation roadmap for organizational success. It translates strategic goal into actionable financial plan, ensuring that resources, personal capital and time are directed toward most profitable activities. So it is a financial blueprint which helps the organization to achieve its strategic objectives and which is converting organization's strategic objectives into financial blueprint. Let's move directly into concept. The first budgeting methodology is master budget or static budget. It is a comprehensive plan to entire organization for a specific period. It is constructed for a single level of activities or for a single projected level of activities. Again, it serves as a benchmark for performance. Now, static budget means if a company assuming that it expected to produce and sell 100,000 pieces or 100,000 units in the next period, the static budget is developed based on that specific activity level. But it has a major limitation. It is failing to account the changes in the activity level. Suppose if the static budget is developed for 100,000 pieces, suppose the company is produced and sold only 900,000 pieces, this difference or these changes in the activity level not considering in the master budget. Again, it is a fixed in nature or static in nature. It account all the expenses, all the other activities based on this budgeted level of activity, that is 100,000 in our example. It has a major limitation. It failed to account changes in the volume. So in simple terms, master budget or static budget is prepared based on a predetermined activity level, and it consider all the expenses, all other related activities based on that predetermined activity level. It can be predetermined activity level can be number of unit expected to produce or number of unit expected to sell, whatever it can be. Now we will move into flexible budgeting. Flexible budgeting is similar to static budget, but only a key difference is it adjusts the original master budget to reflect the actual level of activity achieved. Again, it holds per unit variable cost constant and comparing them to actual result at the actual volume. In the master budget, you have developed a fixed budget or a static budget for 100,000 pieces or 100,000 unit of activity level. But in the flexible budgeting, it consider instead of telling an exact production cost, it split the total production cost into fixed and variable, and fixed will be always fixed, whatever is the activity level, fixed cost will be remain fixed, but the per unit variable cost which will change based on the activity level, total per unit variable cost will change based on the activity level. So the flexible budgeting is a tool to evaluate the actual result with the actual volume. So in this same example, the company budgeted to produce 100,000 pieces. In the static budget, if the company is produced only 90,000 pieces only, in the static budget, it is very difficult to measure the performance in this case, but because you developed your whole budget for 100,000 pieces and you achieved only 90,000 pieces. But when it comes to flexible budgeting, you can convert your budget into an activity level of 90,000 pieces and you can compare your budget with your actual result to evaluate the operational efficiencies. Now let's move to project budgeting. Project budgeting is a budget which is developing for a specific purpose or specific project. A project can be constructing a new plant or launching a new product. These require long-term planning and the integration of all associated costs, including often overlooked indirect overhead. The project budget is pretty simple. It is developed to evaluate the long-term project, or it is developed for long-term projects like a construction of a project, a building or warehouse, or development of a new product. It should be a specific project. Now let's move to next concept, that is Forma statement. Forma statements are what if scenarios. They are not the part of the formal rigid control process used for various analysis. Instead, they are planning tool used to simulate the impact of a strategic decision before they are implemented. Suppose if the company made a strategic decision, the Forma statement, Forma financial statement help the company to stimulate the financial result of that strategic decision before it's implemented. So which will help the companies to make decision and to see the financial impact of their strategic decision before implementing that particular strategic decision. Let's move to key formulas in this session. The key formula is related to flexible budgeting. In the flexible budgeting, you have to rebuild your actual budget or a flexible budget based on the activity level. So the flexible budget amount, how to calculate the flexible budget amount? Standard variable cost per unit plus actual unit produced or sold plus total budgeted fixed cost. The fixed cost will remain stable or fixed with related to activity level, but the variable cost, total variable cost will change based on the activity level. Let's move into a case. Suppose your static budget planned for 100,000 units with a variable cost of 50 per unit and 20,000 in fixed cost. Suppose actual production turned out to 1,200 pieces. The first thing you have to recalculate your total variable expenses. That is 1,200 into $50. That means 60,000 is your budgeted variable overhead expenses plus the unchanged fixed cost, that is 20,000. So your total flexible budget is 80,000. Just a quick summary what we discussed today. Static budgets are prepared for one planned volume. Again, flexible budget are adjusted for actual volume attained or actual volume achieved. Then flexible budget isolate performance variances by neutralizing the impact of volume changes. In flexible budgeting, you cannot rely or you cannot tell I didn't achieve my performance because of the volume changes, because flexible budget is isolate performance variance by neutralizing the impact of volume changes. Again, the fixed cost will not change in flexible budget calculation, which remains same within the relevant activity level. Project budget cover the entire lifespan of an initiative and must be integrated into organization master budget cycle. Project budget is prepared for a specific project and which cover the entire lifespan of a specific project. Some studies tips. Again, if you are looking into the variance analysis in the flexible budgeting, you always look into the direction of that analysis as well, whether it is a favorable variance or unfavorable variance. Favorable variance mean you have a saving over costing, or you have achieved in revenue more than you budgeted, that is a favorable. Unfavorable mean your cost is higher than budgeted, or your income or your revenue is lower than projected. Again, if you are comparing actual result with the flexible budget result, first you have to convert your master budget into flexible budgeting before comparing your flexible budget with your actual result. Again, in the examination, if a question asks what if scenario, assume it is a pro forma invoice or pro forma document or pro forma income statement, and if it is using performance control, assume that it is a flexible versus static budget. So before winding up, here are some cases to test your understanding. If a company experiences a 10% increase in the production volume, but total fixed cost remains same, why does the unit cost decreases? Suppose if a company increase its production volume 10%, still the total fixed cost will remain same. If you are distributing your total fixed cost with your total production volume or total production volume, at the same time your unit cost will decrease. Let me tell you an example. Suppose your fixed cost is 100,000 and your planned production is 10,000 pieces, which means your fixed cost per unit is $10. Suppose if you increase the production volume by 10%, that means you increase your production volume to 11%, still your fixed cost, total fixed cost remains stable as 100,000. In this case, your fixed cost per unit is less than 10. It will be 9 or 9 point something. Now let's move to case number 2. If your static budget unit for 5,000 unit included 100,000 in variable cost and 50,000 in fixed cost, what is the total flexible budget for 4,000 actual unit? In this question, first you have to convert this total variable cost into per unit variable cost. If you divided by 100,000 divided by 5, which means $20 is your variable cost per unit. Now you have to calculate your total variable cost with the activity level. That means 20 into 4,000, it is 80,000. This is your variable cost for 4,000 pieces or 4,000 unit, plus you have to add 50,000 as fixed cost. So it will be 130,000 is your flexible budget cost for 4,000 actual unit. Now let's move to case number 3. A manager argues that their department failed to meet the static budget because sales volume was low. Is a flexible budget useful in evaluating the manager's actual production efficiency? Why? Yes, the answer is yes. The flexible budgeting is useful to evaluate the manager's actual production efficiency because the flexible budgeting is adjusting your budget, your static budget with the actual volume or actual unit achieved. So the flexible budget is useful to evaluate manager's actual production efficiency. This is about today's discussion. If you have any doubt or you need any clarification on any of these topics, please ask me on the comment section. Thank you for watching this video.